Welcome to another weekly recap. Let's talk about Monday, April 28th to Friday, May 2nd. First up, February's monthly S&P Case-Shiller Home Price Index. This is published on the last Tuesday of every month and essentially helps us gauge what stage we are in within the single-family housing cycle. Here's a great example of that. If you live in really any large metropolitan city, then this was probably considered within the index of large cities in this country. For some context, this was showing some marginal hope at the beginning of this year, since basically plateauing or decreasing since July. So where are we now? What did we see this past week? Well, to no one's surprise, it's still slowing down. 4.5% in February compared to 4.7% the month before January. The National Broader Index concurs within about 20 basis points, 0.2%, on a slower pace on a month-to-month basis. Most people do expect this to slow down a little bit more as we head into the busy summer spring season. While this might actually sound like bad news, it could potentially be good news in returning to a healthier housing market. Don't just take my word on it. Here's HousingWire's lead analyst, Logan Mohtashami.
I would not be having this conversation today if home prices were running at like say 6.2%, above wage growth, above inflation. If inventory was not growing as much as it did, right? The 2023 data. I would not be having this conversation today. If purchase application data was negative and home sales were trending below 4 million, I would not have this conversation. But you have the framework and it's all here. And this is how data mining works. It's interesting because the existing home sales report, you see this, the February report was much stronger than anybody anticipated. There were some variable factors into that. So everyone was looking for a decline month to month. But for me, I was like, listen, we're gonna get a decline. We're gonna be a tad above 4 million. That's what it was. But the trend right now, even with elevated rates, positive for the year. Right, we had a 4.2 million forecast for the year. So we can grow sales even with elevated rates, but just getting towards 6 now looks even better. And I think that the healthier backdrop is inventory is growing, price growth is cooling. Think about housing next year, 5 years, 10 years, 100 years. You needed this because this is typically what has happened in previous decades, and it looks normal to me where you could get rising inventory, rising sale. That's the chef kiss. It is positive that equilibrium is coming back to normal.
While inventory is increasing, there is still a huge imbalance between supply and demand. It could take years for supply to catch up to the demand, and that's assuming no additional demand, which is inevitable. I say this because accurately priced listings are still selling, and maybe even with multiple offers. Those that are outdated or corners cut, overpriced, they get stale. They sit and end up selling for the same amount most often, just taking longer. Next on the list, we got pending home sales. A perfect example of accurately priced listings selling is that pending home sales actually had a huge jump, 6.1% from the month before. Mind you, this is still 0.6% less than March of the previous year. Interest rates did have a slight decrease to 6.65% in March, so that likely contributed to it. Remember that pending home sales do not guarantee sales, but it is certainly a good implication of demand. And we are moving right over it, and we are moving right into consumer confidence. The gloomiest of reports, yes, this decreased once again for the 5th consecutive month, and now the lowest since May of 2020. And we all know what happened then. Future expectations are not any better. Business conditions, employment prospects, future income, all negative in the next 6 months. It gets worse because the number of consumers expecting to be jobless within the next 6 months has never been as high as April of 2009. Again, I'm sure we all know what happened then. And this segues right into our next topic of initial jobless claims. This did surge by about 241,000 and definitely higher than expectations. This was an 8% increase from the week before, and while yes, it did rise, the overall unemployment rate held steady. When it comes to unemployment, keep in mind that we are working from pretty historical lows. Furthermore, we added 177,000 jobs last month, which is still less than the month before, but not as bad as forecasters expected given the mass amounts of government layoffs. This is going to be very important to keep a keen eye on because it will be a very strong indicator of the economy. If we start seeing consistent 20 basis point increases, beware. Employment and wages have been two of the real strongholds since inflation and all this unaffordability started picking up. Next up is PCE Index, the personal consumption expenditures for March of 2025. Now, as we all might know, there's core and then there's non-core, or whatever you want to call it. Core specifically is supposed to be less volatile, excluding food and fuel. And this is the Fed's preferred gauge of inflation. Ironically, while it's supposed to be less volatile, it actually increased by 2.6%, whereas non-core increased by only 2.3%. This is a low increase, which is good, obviously. Nobody wants high inflation, but it is more than economists expected. Mind you, this was all before April 2nd, or what a lot of people are calling Liberation Day, the day that tariffs were announced, and that is contributing to a lot of buying right now, which could also ramp up inflation and will lead us right into our next topic, GDP. And I'll tell you why. GDP is being considered as one of the most important pieces of data over this past week. Why? Well, because 2 consecutive quarters of a decrease in GDP is widely considered the beginning of a recession. And you guessed it, we got our first quarter of the decreased GDP. This was at an annual rate of 0.3% over January, February, and March. But what's important here, and what is always important, is asking the question of how did this happen? Let's break down how GDP is calculated. GDP equals C plus I plus G plus X minus M. C is consumption, I is investment in the economy, G is government spending, X minus M is the difference between exports minus imports. And that's where we find our real cause. While government spending was also down, which could have contributed, we had a huge influx of imports. This is thanks to the upcoming tariffs. People want to get their supplies in now so that they don't have to pay more for it when those hit. What that means is that we consumed more than we gave, so it's a negative. The last of those non-tariff shifts are coming in now, so be prepared. Thank you so much for watching. Let me know what you think about the future and this past week's data. I look forward to seeing you in the next one.